Hi, everybody. It's Michael Haas back for another episode of Debits and Credits with Haas and Dawe. And today we're going to talk about, well, from my lips to God's ear type of conversation regarding the real estate economic forecast. It's an interesting situation going on right now because we don't really know what exactly is going to happen from the federal side of things, as interest rates continue to be a very delicate situation. From a mortgage standpoint, we want interest rates to be lower, but the Federal Reserve Board, which will be having a meeting later this week, is going to determine what it wants to do with the overall discount rate, with the money supply relative to inflation, with the war in Iran, with some of the other markets going on across the globe as to what it wants to do. Now, also, what's interesting is that the interest rate itself for mortgages is not dependent upon the Federal Reserve. It's influenced a little bit, but it really the interest rate for mortgages is more based on the 10-year Treasury notes, and that's something that Congress tends to set more than the Fed Reserve does. And Congress is concerned about the deficit, and Congress is concerned about the investments that are coming from our what we call asymmetric allies, the European market, from Great Britain, from Japan, South Korea, even Mexico, as to what's going to be happening to the investment in our national bond market, because that's something that's important as far as handling with our deficit and where our capital is coming from for the country. Now, with interest rates, we think they're going to settle in the as far down as the mid 5% range, and probably up to the low sixes, maybe 6.25% range. Commercial interest rates will be a little bit higher, but what's going to happen is there's going to be a refinance market, we think, coming up. Refinance market, because there were a lot of people who bought houses and buildings in 7% market and an 8% market. And now that the interest rates are down into the sixes and mid sixes and maybe even a little bit lower, once an interest rate goes down by 1% or more, it makes sense to do a refinance. The fees are absorbed into the cost of the refinance, and it's affordable at that point. And a 1% drop in the interest rate makes a big difference in the monthly payment. So we think there's going to be a refinance market that's going to be moving upward with activity. And then a refinance market, that tends to then create other transactions. Refinances lead to resales and purchases. And also with what's going on with the rates of what it costs for rent. The rents are high, sometimes higher than a mortgage payment. Then it's going to be a matter of going from buying into a condo. And then people who buy condos then want to buy townhouses. And those people then want to buy single family residences. So this is how the typical market tends to flow. And we think it's going to be positive going forward. We think there's going to be a market for commercial relative to lending and refinancing, because the fact that so many commercial buildings were refinanced in right during COVID and right after COVID, that it's going to be time for those loans that were 5 to 7 year loans coming up for refinances. The residential market, we think, is going to be positive for refinances, because there's going to be activity relative to the drop in the interest rate. Now, in buying residential, there's a couple of factors that people are concerned about. It's not so much the mortgage payment itself relative to a rental payment, but it's the down payment. And the down payment can be anywhere from 3% up to 20% or more. Why the 20% is a threshold people need to be concerned about is if your down payment is less than 20%, meaning the amount of the loan is greater than 80% of the purchase price of the property, then the lender's going to want what's called an impound account, where you're going to pay with your mortgage payment every month. You're going to be making a payment toward property taxes and property insurance, the homeowner's insurance. So what the mortgage company will do is take 1/12 of your property tax and 1/12 of your insurance premium and charge it on a monthly basis. The mortgage company will collect the money, and when the property taxes are due, the mortgage company will make the property tax payment for you and pay the homeowner's insurance payment for you. That's why 20% is a key factor. If you can put down more than 20% on the purchase of the house, then you do not have to do an impound account. You can elect out of it. Now, the down payment, which is obviously at 20%, that's a significant number with what the cost of houses are, even condos and townhomes. The down payment is no worse from the economy standpoint than it was in 2019, even before COVID. It's still been a difficult process. And so people are looking at the fact that maybe there's going to be multi-generational ownership of the property, or maybe even multi-generational occupation of the property of the house. Or it could be that you've got families with gifts of the down payment for the children, or you're going to have where the parents will be on the mortgage, not necessarily on title, or maybe both on the mortgage and on title, to help the kids get through getting qualifying for the loan. There's also an interesting program called an 80-10-10, where the loan is 80% of the cost of the house. It's a 10% down payment from the buyer, and then there's a second on the house for another 10%, helping to pay the rest of the down payment. 80-10-10. 80% for the mortgage, 10% for another loan for the rest of the down payment, and 10% of actual cash down payment. There's also a program from FHA, the Federal Housing Authority, which is for first-time home buyers, where it's a 3% down payment and a 90% loan. Or to help people with the down payment, you can get a 3% down payment, and the FHA will coordinate a 90% loan on the property. Now, first-time home buyer isn't necessarily only a first-time home buyer. It's a first-time home buyer, plus it's also someone who hasn't owned a property for over 2 years. They also can qualify for this first-time home buyer program, 3% down, 97% financing. There's also things called seller carrybacks. A seller carryback is where instead of going to a bank and getting a loan from a bank with a mortgage, the seller's willing to carry the paper. The mortgage will be in the name of the seller, and this way it prevents the buyer from having, or keeps the buyer from having to go and qualify for a loan from the bank, which makes it easier to buy the house. And if the seller is willing to carry the paper, it can be anywhere from a year to 10 years to 15 years of a note term. It's at a higher interest rate than the traditional mortgage, which is attractive to the seller because they're going to make more money on this investment than they will if the money had been invested, let's say, in a bank, or perhaps in some sort of a CD, or in a treasury bill. So it's something that's attractive to them. And then they're going to carry forward as they go ahead with the over the life of this term of the loan, collecting on the note from the purchaser every month. And it could be interest only, it could be principal and interest, it's whatever the seller is comfortable with. And then what also is this buyer is able to do is, let's say it's 2 years into the note, or let's say that the note even just has a term of 2 years. Then it gives the buyer 2 years to build up some equity in the property, and then go and qualify for a traditional mortgage, or what they call a conventional loan from a bank. And so it's a convenience. There's also something that was attractive in the 1980s that's come back for a short time, called an all-inclusive trust deed, an AITD. This is where, again, to help the buyer who can't qualify for a traditional loan to take out a loan called a wraparound, where the loan is enough to cover the entire debt, but the seller still has to pay on the underlying or the existing mortgage that the seller had. And so the buyer is paying enough to the seller to pay for the mortgage on that existing loan, and then paying the seller for what the equivalent of a carryback. It makes sense when there's a high interest rate situation, like the 1980s was very bad with double-digit inflation and double-digit mortgage rates. In this case, let's say the mortgage rate that the buyer could qualify for would be 7 or 8%, and the seller's got an existing loan right now for 3%. Well, it makes it attractive because there's such a differential between the existing debt at 3% and what can be a carryback at 7 or 8%, that the buyer is willing to do that, and the seller is willing to continue to make the payments on the existing, because the seller is making money on the overlying wraparound loan at 8%. But it's something that has only specific usage to it, and again, as interest rates are coming down, this AITD will become less attractive. Now, for investors, another attractive situation that's still being active and is continuing to move forward is the 1031 tax deferred exchange. That's where, let's say you have a seller who owns a commercial piece of property or investment piece of property, such as an apartment building or a house that's being rented out, and for whatever reason they want to sell that property. It's not bringing enough rents. They feel it's maximized on its value, so they want to sell it, but they don't want to pay the tax on it yet. So they do this section 1031. That's the Internal Revenue Code section 1031, deferred tax exchange. So what they're doing is whatever the property sells for, all that money that's coming out of that sale is going into buying a new property. And there's specific regulations in the Internal Revenue Code and in the Treasury regulation sections of the code to talk about how to do this exchange. And so what happens is any money that comes out of the sale of the property goes to what's known as an exchange accommodator or a qualified intermediary, a QI. And so what this exchange accommodator does is they hold the money until the seller person has found the property they want to buy into. So that it's like they're exchanging properties. Now these exchanges can be done on a concurrent basis, meaning two people that each own properties and they want to exchange properties, and so they just do deeds transferring the property from one to the other and other to one of the two properties. That's called a direct or a concurrent exchange. But for these deferred exchanges, it gives the seller person time to find a piece of property they're happy with. And then what the rules are is 45 days after the sale of the property, the seller, exchanger person identify no more than 3 properties of options that they can buy into. Well, I can amend that. They can actually exchange more. They can actually identify more than 3 properties, but the total value on all the properties they provide cannot be more than 200% of the property they sold. Well, they identify properties within 45 days, and then within 6 months, within 180 days from the sale of the original property, the exchange person, the seller, has to buy and close on the new property that they want. And it's a very, very strict 180 days and a very strict 45 days. If these rules, if these dates are not held up to, then the exchange is blown and the seller is going to have to pay tax on the original sale. We also think that what people are called investors or flippers, where they're flipping property, they're going to be getting back in the market now because interest rates are back down at a reasonable amount where they can buy a piece of property and within 2 to 3 months they can fix up the property and then they can sell it and make a profit on it. And so I think we're going to see those people getting back into the game. We're already seeing the developers are getting more active again. And these are people who are dealing more with commercial property or where they'll buy some vacant land, or they'll buy an existing property with an existing home on it or an existing building on it, and they will either redevelop the property into condos or townhomes or into a warehouse or an advanced commercial piece of property, or they may just tear down the existing improvements that are there and start from scratch. And so developers are starting to get into the game as well. And so it's a situation that you're seeing more activity from that point. So we're thinking even in this month, and we're in June of 2026, we think that there's going to be activity coming along. But over the course of the rest of the year, we think there's going to be more activity coming along. There's going to be a positive real estate market. The next 7 to 9 year positive cycle has started. Mortgage rates are starting to be softening. And so we think that's going to be a very positive remainder of 2026 when it comes to the real estate market. That's today's episode of Debits and Credits with Haas and Dawe. We'll see you again in the next episode. Thank you.